Most traders focus on direction. Professionals focus on volatility. Because when volatility expands, markets move faster, option premiums reprice aggressively, and opportunities appear across multiple asset classes. Or here's the important distinction. Professional traders do not wait for chaos to happen randomly. They prepare for volatility expansion before it arrives. In this video, we're going to break down how professionals identify volatility, anticipate expansion phases, structure trades around increasing implied volatility, and manage risk when markets begin moving aggressively. So what is volatility expansion? Volatility expansion occurs when price movement accelerates after a period of compression or low volatility. This happens in equity indices, individual stocks, commodities, currencies, bonds, and even cryptocurrencies. Markets consistently rotate between compression, expansion, stabilization. Now, professional hedge fund traders understand this cycle extremely well. One of the most important concepts in trading is this: large moves usually begin from quiet conditions. That means professionals often become most interested when retail traders become bored. You'll frequently see volatility expansion after, say, economic reports or central bank announcements, earnings releases, geographical events, technical breakout levels, and liquidity imbalances. The goal is not predicting the future perfectly. The goal is positioning for opportunity when volatility begins to expand. Professional traders look for signs that volatility is compressing before expansion occurs. Some common indicators include tight trading ranges. When markets trade increasingly narrow ranges, energy begins building, or there's a declining ATR. Average true range measures movement size. When the ATR declines significantly, it often signifies compression. The Bollinger Band squeezes, and as Bollinger Bands tighten, traders recognize that realized volatility is falling. Eventually, markets typically break out of these compressed conditions. If implied volatility becomes unusually low relative to historical movements, institutions begin preparing for repricing opportunities. One major difference between amateur and professional traders is understanding implied volatility. Implied volatility simply means it's a reflection of the expected future movement price of a particular option. The realized volatility reflects what is actually happening. Professionals compare the two consistently. If implied volatility is extremely cheap relative to the potential movement, traders may position long volatility. If implied volatility becomes excessively expensive, traders may look for premium selling opportunities after expansion stabilizes. This is where volatility trading becomes less about prediction and more about probability and pricing inefficiencies. Now, here are several strategies professional hedge fund managers commonly use. Long straddles. A trader buys both a call and a put at the same strike price. The objective is large movement. If volatility expands aggressively, the position can benefit regardless of which direction. However, timing matters greatly because theta decay can become significant. The next is long straddles. Similar concept, but using out-of-the-money option. This lowers cost but requires a larger movement. Then there's the debit spread. Professionals frequently reduce risks using spreads instead of outright long options. Debit spreads help control premium exposure, reduce their decay, and define risk precisely. And one of my favorites are calendar spreads. Institutional traders sometimes exploit differences between short-term and long-term implied volatility. This can become especially effective around scheduled events. Volatility expansion creates opportunity, but also increases risk dramatically. One major mistake retail traders make is increasing size emotionally during fast-moving markets. Professional traders often do the opposite. They reduce exposure when volatility becomes unstable. Why is that? Because bid-ask spreads widen, slippage increases, and correlations break down with liquidity. Professionals understand that surviving volatility is more important than maximizing one's trade. Institutional traders focus heavily on position sizing, correlation risk portfolio exposure, vega exposure, and liquidity conditions. Many hedge funds survive for decades not because they always win, but because they avoid catastrophic losses. Retail traders often struggle during volatility expansion for several reasons. They are typically chasing after the move. Professionals prepare before the expansion. Retail traders often enter emotionally after the move has already happened. They oversize their positions. Fast-moving markets create emotional excitement. That often leads to excessive leverage. They ignore implied volatility. And many traders buy options after the implied volatility has exploded higher, which means option premiums are the most expensive. Even if direction is correct, volatility collapses and can still damage the trade. Many hedge funds treat volatility as an asset class itself. The objective is not simply predicting direction, it is identifying mispriced risk. This is why professional volatility trading becomes highly quantitative. Many firms use statistical modeling, machine learning, and real-time option analytics to identify opportunities invisible to most retail participants. Volatility expansion is one of the most important concepts in professional hedge fund trading. Professional traders understand that markets alternate between quiet conditions and explosive movement. The key is preparation, not reaction. Because in professional trading, volatility is not simply danger, it's an opportunity when understood correctly. Hey, if you'd like to learn more about Frank Nag, click on the links in the description box below.